Hey, this is Matt from InvestiQuant. Today is Tuesday, July 20, 2021. This morning, the markets gapped up, and after just a short, brief period of consolidation, they took off to the upside, and we have been trending higher since then. We opened right here in the S&P, which is just a little bit above yesterday's close. We checked down, tested the closing price, and then took off from there. Our range is quite sizable. We're over 70 points of intraday range here in the S&P, which is quite a bit larger than what we've been doing in our ATRs. Our ATRs for the 5-day ATR is currently around 43, so we have much more range than we have been averaging here in recent measurements of volatility, and we are trading up near the highs. We've got a trend day that has formed, and we're going to be looking at that this afternoon. What has happened historically when you get this type of trend day activity in a similar market environment? So I've gone ahead and selected all four instruments. The setup we're going to be looking at will be based upon entering the market long at 3 p.m. Eastern Time and exiting at 4:15 p.m. Eastern Time. Now, for opening filters, we gapped up this morning. We did not open above the prior day high in the S&P. We did in the NASDAQ, but we didn't in the S&P. So I'm just going to keep this at gap up, and that will make it more applicable here. Next, I'm going to go into post-open filters, and I'm going to say three different key pieces of information here. So the first piece of information I'm going to add is that we have strong range. And the way I'm going to do that is I'm going to type in a minimum range here of 125%. What this is saying is the intraday range, which is measured between the open of regular trading hours, 9:30 a.m. Eastern Time, and the time of entry, which I've got set to 3 p.m. here. So this is saying that intraday range is at least 125% of the 5-day ATR. And the 5-day ATR, at least in the S&P right now, is about 43 points. So we are well over that 125 percentage marker there that I'm using. And then next, I'm going to say that we opened near the lows and we're trading near the highs as of 3 p.m. I don't know if we're going to be at the highs near 3, but we currently are. So I'm going to go ahead and use that as one of the filters. So to do that, I'm going to go open versus intraday range. I'm going to say equals next to open and bottom 25%. And then I'm going to put equals next to close. Oops, wrong button there. Close in top 25% of the intraday range. So that makes the directional up candle-like pattern that is forming on the daily candlestick right now with the good range. So I've got that selected. Lastly, I'm going to put it in a similar market environment where we are coming off of recent lows. So we closed below a 10-day simple moving average yesterday, but above a 200-day simple moving average. So that will complete the study. Now I can click View Results. And here we go. These are the results based upon entering the market long at 3 p.m. Eastern Time, exiting at 4:15 p.m. Eastern Time, when you get a gap and go up type of scenario in this weak bullish market environment, which I've defined as below a 10 and above a 200-day simple moving average. So historically, the way I've defined this, with the range being greater than 125% of the 5-day ATR and then opening near the lows and trading near the highs at 3 p.m., this has been a really rare scenario. Now, part of that is due to the range requirement of it being 125% of the 5-day ATR by 3 p.m. That's going to get rid of a lot of different days where you just don't have that much range at 3 p.m. The other is being in this weak bull market environment as well. We probably have more of these in some of the different market environments. But regardless, we do not have a whole lot to look at here. So the S&P has 14 samples dating back to 2003 of this pattern. The NASDAQ has 24. The Dow and the Russell both have 14. So this is extremely rare. And whenever you're looking at something that has sample sizes this small, you do kind of want to keep that in mind. You don't want to put too much weight on something that just doesn't have a whole lot of samples to look at. But what we can see here is, out of the four here, none of them have been strong. We do see a couple that have been quite a bit weaker historically, with the S&P coming in at 29%. The Dow is coming in at 29%. And then the NASDAQ and the Russell are a bit more neutral. The NASDAQ at 46, the Russell at 57. So I don't really see anything here that is strong. And I see a couple that are weak, but they are on smaller sample sizes. So I'm kind of reading this as a mixed pattern between all four instruments here. Just a touch weak probably overall. The average win and average loss on these, average win has been larger in the S&P than the average loss. For the NASDAQ, those numbers are extremely small in either direction, but the loss has been a little bit larger. That's the same case for the Dow, just really small numbers there. And in fact, if you look at the equity curve, you can see the last time that happened in the Dow, it looks like it was about 2017. That's how rare this has been. If I hover over this green equity curve here, that's the Dow equity curve. You can see it ends there somewhere around the end of 2017, which means this has not taken place in the Dow since then. So again, just really rare scenario here. And then Russell average win is larger than the average loss. So to me, this is a mixed study. I don't see anything that stands out as strong whatsoever. A couple of them do lean towards the weak side, but it is on a small sample size. So keep that in mind. Good luck the rest of the day, and we will see you next time.